Stop everything right now and look at this number, $85. That is where silver is sitting today, February 5th, 2026, after one of the most savage crashes anyone in this market has ever seen. 41% gone in a matter of days, from $122 peak late January all the way down to the $72 absolute bottom. Now bouncing back toward $85 with real conviction behind it. Most people staring at red screens think the bull market is dead. Precious metals are finished. The party is over. But hold on tight, because what almost nobody is connecting right now is that this bounce is not random noise, and the signals coming in, especially after yesterday's U.S. Critical Minerals Ministerial, are pointing to something very different. By the end of this video, you are going to see three major things the mainstream financial media has completely ignored. Three things that tell us whether $85 is just a temporary trap before the next leg down, or the starting line for the next powerful move higher. If you are still holding silver or thinking about buying more on this dip, stay locked in. This could be the most important 12 to 15 minutes you spend this week. Welcome to the channel that looks behind the curtain at the moves big outlets will not touch. If this kind of real-time breakdown hits for you, subscribe right now and turn on notifications. We are covering this story every single day while it is moving fast. Let us jump straight in. First, I need to set the stage quickly so the rest makes sense. Silver did not just rise slowly, it exploded, from roughly $30 an ounce in early 2025 to $122 by late January 2026. That is more than 300% in 13 months. Gold went along for the ride and smashed all-time highs above $5,595. The rally had three huge drivers: central banks buying aggressively to diversify away from the dollar, massive industrial demand from solar panels, electric vehicles, 5G infrastructure, semiconductors, defense electronics, and a wave of retail and speculative money chasing momentum in the final weeks. Silver alone jumped over 50% in January. Every night, Asian buying pushed prices higher. Every morning, Western traders opened two gaps they could not catch. Then everything reversed in one brutal week. Exchanges hiked margin requirements sharply. Leveraged positions got force liquidated. Algorithms started selling into each other. The cascade was unstoppable. Single-day drop of 37%. The worst session since the Hunt brothers squeeze in 1980. Total peak-to-trough damage, 41%. Silver touched $72. Gold lost more than 20% from its top. Panic was everywhere. Forums filled with sellers regretting their timing. Headlines called precious metals a bubble that finally popped. But then something shifted. Silver did not keep bleeding. It bounced, 18% off the lows in just a few days. Now trading around $85 as we speak, dead markets do not bounce 18% with conviction. They grind lower or flatline for months. This bounce has buyers behind it. Real buyers, not just short covering. So who stepped in, and why right now? That is where the three things nobody is talking about come in. Number one, the east-west price divergence is not closing, it is still very wide. While Western paper markets were crashing to $72, physical buyers in Shanghai were paying 25 to 30% higher for the exact same metal. Same purity, same element on the periodic table. Two completely different valuations in real time. Even when Shanghai futures hit limit down and trading halted to prevent total chaos, their absolute floor price converted to dollars was still $12 to $18 above where Western futures were freely collapsing. That is not retail panic selling. That is strategic, deep pocket accumulation happening at scale. And it was not casual investors. These were entities with long horizons who see the paper price as disconnected from physical reality. Number two, one of the largest Western precious metals trading houses made a very public strategic pivot. They did not open another desk in New York. They did not expand in London. They relocated a major part of their precious metals operation to Asia, Singapore specifically. Traders, analysts, technology infrastructure all moved across the world. This is not a small office upgrade. This is a multi-million-dollar, multi-year repositioning. Institutions do not spend that kind of money on a quarterly hunch. They do it when their internal models show the center of gravity for these metals has permanently shifted east. Asia is where the physical demand is exploding. where central banks are building reserves year after year, where premiums on real metal are persistent and real. This move is a loud signal that the future of precious metals trading is no longer anchored in the traditional Western hubs. Number 3. Yesterday's U.S. Critical Minerals Ministerial. Delegations from multiple allied nations, hosted by Secretary Rubio at the State Department. Official stated goal: strengthen and diversify supply chains for critical minerals essential to national security and technology. When governments use phrases like strengthen and diversify, they are almost always saying the same thing. We have a serious exposure. We are dependent on supply chains we do not fully control. We need to lock this down before it becomes a crisis. And silver is sitting right in the center of that discussion, more than almost any other mineral on the list. Why? Because silver is not primarily jewelry or investment coins. Silver is consumed, used up forever, in massive quantities every year. Last year alone, industry took over 650 million ounces. That is more than half of global production disappearing into products. Solar panels require silver paste for every cell to convert sunlight efficiently. Electric vehicles use it in batteries, wiring, contacts. 5G towers and base stations need it for high-frequency performance. Semiconductors, advanced defense systems like radar and missile guidance, medical imaging equipment like X-ray machines, all depend on silver's unmatched conductivity. There is no substitute that works at scale and cost right now, and the world has been running a persistent supply deficit for years. We use more silver than we mine every single year. Stockpiles are being drawn down. New dedicated primary silver mines take 8 to 12 years from discovery to first pour, permitting environmental reviews, funding, infrastructure. It is slow. Most silver production is byproduct from copper and zinc mining. Copper mines do not ramp up just because silver is expensive. They follow copper demand cycles. That is the structural trap governments are waking up to. So what could realistically come out of yesterday's meeting? Several concrete possibilities are already being discussed in policy circles. Strategic national stockpiling programs similar to the Strategic Petroleum Reserve, but for silver and other critical minerals to ensure supply during disruptions or conflicts. New bilateral long-term supply agreements with friendly producing nations like Mexico, Peru, Australia, incentives and fast-tracking for domestic U.S. mining tax credits, streamlined permits, government-backed financing, potential export controls or restrictions on foreign entities acquiring domestic reserves. Official designation of silver or groups of minerals as strategic for national security purposes, unlocking priority funding and protections. These are not theoretical ideas. These are the exact playbook steps nations use when they decide a resource is too vital to leave entirely to open market traders and speculators. China has already executed versions of this with rare earth elements, gallium, germanium, export restrictions, domestic stockpiling, strategic reserve building. Now the United States appears to be moving in the same direction. So what does all of this mean when you put the pieces together? The paper, silver market, futures contracts, leverage, margin calls. Algorithmic trading just went through a violent divorce from the physical silver market. Actual metal needed for factories, defense systems, technology, paper crashed 41% in a leveraged unwind. Physical barely flinched. Eastern buyers paid 25 to 30% premiums throughout the panic. Their futures floors stayed well above Western crash levels. A major Western institution repositioned its entire operation toward Asia, and the U.S. government held an emergency ministerial level meeting on critical mineral supply chains the very next week. Timing is never coincidence at this level. Wealth did not vanish in the crash, it transferred. From panicked, leveraged traders who sold at the bottom to patient strategic accumulators who bought the dip. From people reacting to headlines and red screens to people acting on supply-demand, reality, and long-term geopolitics, this is not the death of silver. This is potentially the clearing out of weak hands before the next powerful leg higher. The 1970s gold market is still the clearest historical parallel. Gold ran from $40 to over $200 an ounce. Euphoria everywhere. Then it crashed more than 50%. Headlines wrote obituaries for the bull market. Analysts went on television saying it was over forever. Retail investors who bought the hype panicked and sold at the lows. Then gold eventually went to $850. A 400% plus move from the crash bottom, The people who sold in fear missed one of the greatest wealth creation events in modern financial history. The crash did not kill the trend, it killed the tourists, the speculators, the weak hands. The structural buyers who understood the fundamentals stayed, and they were rewarded massively. I see the same pattern setting up here. Silver went from $30 to $122, crashed 41% to $72, bounced 18% to $85 and holding. Gold dropped 20% plus, then recovered strongly. That is not the signature of a dead asset. That is the signature of a shakeout. Real industrial demand has not disappeared. Solar manufacturers cannot shut down production lines because silver paste is temporarily expensive. EV makers cannot stop building cars because contacts are costly. Defense contractors cannot halt missile guidance systems because of price spikes. Demand is inelastic at these levels. Some large end users are reportedly locking up direct mine supply right now, bypassing exchanges entirely. When corporations start going straight to producers instead of trusting open markets to deliver, that is a very loud signal about future availability. So here is what I am watching very closely this week. The official readout and press statements from yesterday's U.S. Critical Minerals Ministerial, any specific mention of stockpiling programs, silver as a strategic mineral, or new bilateral deals, any executive orders or follow-up announcements in the next 7 to 10 days. The Shanghai premium level, if it stays above 20%, even as Western prices stabilize or climb, the physical market is still dictating terms. Day-to-day price behavior, if $85 holds as support and we grind toward $90 to $100, the shakeout is complete and weak hands are gone. Broader macro signals, if the dollar weakens further or the Fed hints at pausing tightening, that could fuel another leg. This is not financial advice. Markets are brutal and unpredictable. Do your own research. Talk to professionals. Only risk what you can afford to lose. But from where I sit, staring at these charts and data every day, this does not feel like the end. It feels like the middle. The clearing phase before the trend resumes. Drop your honest take in the comments right now. Do you think the bounce to $85 is real recovery, or just a trap before it goes lower? Did yesterday's US meeting change your view at all? Are you adding more silver on this dip? I read every single comment. The sharpest insights usually come from viewers like you. If this video connected some dots you had not seen before, share it with one person who needs to see it. And if you are not subscribed yet, hit that button right now. We are tracking this story every single day while it is moving fast. This is the hidden side of the economy. I will see you in the next update. Thank you for watching. Stay sharp, stay prepared.